I'm Taylor Riggs in San Francisco, and for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, Fed scrutiny. WeWork faces an SEC inquiry into possible rule violations. We'll have details. Plus, probe widens. The multi-state investigation into Google's ad business now expands to the company's search and Android operations. We'll have the latest. And the week that was, Disney's new streaming service proves to be the Magic Kingdom, while the Apple Card still can't shake its credit controversy. We've got analyst insight into those top stories and more. But first, it is all about our top story, and it is WeWork. They're said to face a Securities and Exchange Commission inquiry into possible rule violations into the run-up of its failed IPO. The agency's review was said to be preliminary and may not lead to an enforcement case. The company at one point, as you remember, worth $47 billion before it fell out of favor with investors and needed a bailout from Softbank. For more, let's bring in D.A. Davidson's Barry Oxford and Bloomberg Technology's Ellen Hewitt, who covers the company for us. And congratulations on the story. What do we know so far about the SEC inquiry?
We know a couple things. We know there's an inquiry happening. As you mentioned, it's early, preliminary. We don't know what might come of it. But we do know that WeWork has taken steps to prepare and respond for it. They've hired a guy named Andrew Serezny, who used to be head of the SEC's enforcement division. He now works in private practice, and he's coming on to help them respond to this. And this is, this is also coming from the SEC's enforcement division, which is the part of the SEC you don't want to be hearing from. So although we don't know exactly what is prompting the probe, I think we noted in our story that this is something that is somewhat expected, given all the coverage that's been happening around WeWork. You might expect the SEC to come in and kick the tires a little and see what's going on, or make sure people are holding documents that might be necessary later.
So, Barry, in your opinion, somewhat expected, given how high profile this company was, or is this indicative that something much more serious is going on?
I think that, this is more predictive. The fact that it's a failed IPO, and it was very, it was a very prolific IPO out there. That being said, we all know that Adam runs kind of an aggressive style when it comes to management, and so there might have been maybe some aggressive accounting going on within the firm. But I think that's as far as I would want to take it at this particular junction.
Barry, you talk about aggressive accounting. One thing that caught my eye was community adjusted EBITDA. You know more than I do. I don't believe that's in the GAAP or the IFRS rules. It's certainly not in a CFA curriculum. What the heck is community adjusted EBITDA?
Well, I think that, being a REIT analyst, I'm used to non-GAAP measures, funds from operation, adjusted funds from operation. That's kind of par for the course. It's just a way for WeWorks to get the investors to kind of concentrate on the NOI that the individual units are throwing off, and then what they're saying is, okay, then let's look at the other cash that's being spent to bring new ones on board. So, is it straight down the middle type of accounting or the way to look at things? No. But to be honest with you, I did find it a little bit helpful. Not that I was relying on it, but I did find it helpful.
Ellen, are the financials what is the biggest concern for the SEC at this moment?
So again, we don't know, but it is interesting to have looked at the evolution of the S1 document over time as well. So as you mentioned, community adjusted EBITDA was one of their more infamous metrics that first popped up when the company started selling bonds in early 2018. This was a metric that came out in documents associated with the bond sale. And if you look at the past early drafts of the S1 on the SEC website, you can see that community adjusted EBITDA is actually in there up until maybe around May or June, and then it gets cut from the drafts and was not in the final prospectus that was made public in August. So it seems like they were also behind the scenes as they prepared for what is now not an IPO, but as they prepared for what they thought would be an IPO, they were adjusting some of their metrics as well. I don't know what the SEC is most concerned with, but that did seem like something that could have raised eyebrows.
Barry, outside the financials, did anything else catch your eye? The valuation, the conflicts of interest, as you were analyzing this company, what sort of other potential violations, for lack of a better word, really stood out to you?
Well, I mean, I think that we've kind of been over, the corporate governance and the way Adam was kind of paying himself. $5 million he was trying to get personally for the WeWork's name. We saw that in the document, and then when there was the revised S1, that was not there. So we see kind of aggressive things kind of going on within the document that investors wanted to see changed.
Barry, what would you like to see from the company next?
I think that with new management team, they need to really hone in on showing a profit. And I think in order to do that, what they need to do is sort of kind of stop the burn rate and stop signing new leases, maybe not cut it down to zero, but really pull back on signing new leases and really concentrate on taking the projects that are already kind of in the pipeline and getting those units to stabilization. When I was looking at the S11, about 1/3 of the units were stabilized. So that's another 2/3 that were kind of in some sort of process of trying to get to stabilization and some sort of full occupancy. I think that if they can concentrate on that, they will show profitability. Now, like anything in life, there's no such thing as a free lunch. But by doing that, what you're going to do is you're going to really slow the future growth rate of this company. And I think that's why the valuation got run up, because you had a fairly big company doubling revenues every 12 to 18 months. There's not a lot of big companies that are doing that. So the valuation will really have to come off, given the fact they're not going to have that kind of growth rate going forward.
So, Ellen, you've talked a lot and just heard that the focus on profit. If you come and take a look at a chart inside my terminal, we know that bondholders still aren't happy with the way the company is being run. Bonds are 74 cents on the dollar. What next do you need to see from the company about their spending plans, about that path to profitability?
Well, people are going to be watching that their expenses, which have still up until now been going through the roof. Actually, the company on Wednesday gave third quarter earnings, which they shared with bondholders. This is something they've done for the last year and a half. We were able to get some of those numbers, and it showed that WeWork lost $1.25 billion in the third quarter. I mean, and this is at a time, and that's, they only had a revenue of around $970 million. That's just astronomical losses, and people are going to be looking to see if the company can turn that around. Our sources say that part of the reason for that big loss comes from hiking up their expenses in anticipation of going public. They wanted to show strong top-line growth in the first quarter or two as a public company, so they set in motion a lot of things like getting new leases, buying out a lot of furniture and things like that, but it was a little hard to stop that halfway through, so we may still see pretty bleeding losses into 2020.
Well, we will keep our eye on that. Barry Oxford of D.A. Davidson and Bloomberg Technologies, Ellen Hewitt, thank you both for joining. Now, Softbank has quietly completed its initial money-raising push for its second technology fund at a fraction of the targeted $108 billion. The Japanese company has raised roughly $2 billion for the second Vision Fund, so it can start backing startups. This stage of the fundraising process is known as a first close, and Softbank will continue gathering commitments. A Vision Fund spokesman declined to comment. And coming up, searching into Google, the probe into Google's business practices is getting wider. We've got details on what new areas regulators are focusing on. That's next. This is Bloomberg. The probe into possible antitrust behavior by Google is about to get bigger. Multiple U.S. attorneys general are already looking into the company's ad business, and now they'll also put the lens up to Google's search and Android software. The new probes are being helmed by Iowa and North Carolina. Texas is leading the one into ads. Joining us to discuss in D.C., it is Bloomberg's Ben Brody, who covers tech's lobbying efforts, and in New York, Garrett DeVink, who covers Alphabet. So, Ben, let me start with you. What do we know about the additional probes that are going on?
Well, we know that the attorneys general basically divided up the responsibility for these probes at a meeting earlier this week on Monday in Denver. Basically, the attorneys general wanted to expand some of these. There were some staffing questions, and so they decided that they were going to expand and dig deeper into these issues. It's a particularly interesting issue set because, of course, search and Android, unlike ads, are issues where Google has already faced problems in Europe. There are cases that have been made. There are economic analysis. There are known complainers. This is an issue that Google, on the one hand, has been fighting for many years, and it's a playbook they know how to do. On the other hand, this is a well-trod road by enforcers, and in some ways, particularly the Android case, there are echoes of the Microsoft case. That's the most successful tech antitrust case of recent years in the Android case, and so they're going to go down that road now.
Garrett, of all these different probes, which is Alphabet most worried about when it comes to antitrust?
I mean, if you ask them, they say, they're saying we're taking it seriously, but we'll get through this. But, that's a really interesting question. I mean, like Ben said, they've already faced a lot when it comes to Android in Europe. And the ad tech one is kind of interesting because it's a system where Google has gone out and done a lot of acquisitions over the years. So you can really trace Google's dominance in ad tech. And it's something that many people, even those who, invest in companies like The Trade Desk and Criteo, are also a little bit fuzzy about what's exactly going on. Whenever I ask people in the space, okay, explain to me Google's dominance in ad tech, they take a big, deep breath and they say, how much time do you have? And so I think this is one that's going to be very complicated for regulators to really wrap their head around, and that complexity makes it difficult to really punch to the heart of the matter. But when you look at what the states sent to Google asking questions for information, you could tell that the person who wrote that was very, very well informed. And so the states are definitely bringing their big guns to this battle, and I think Google needs to be really careful because this is a space where in some parts of the ad tech market, they have up to 90% market share.
And Ben, in your opinion, is this multi-pronged approach, all of these different probes by all of these different state attorneys general, helpful, or does it appear not targeted?
Well, I mean, there's a saying sort of here in Washington, when you go after people on a lot of different probes, regulatorily, lawmakers, those sorts of things, something eventually shakes loose. It's not necessarily what you want, but I don't think that the attorneys general are too worried here about the optics of this probe. I think they're going to buckle down. They're going to learn more about these issues. As Garrett said, there's a lot of education that now has to be done. They're going to want their document demands going forward to look as specific as the ones that they issued on ads. So they have to buckle down and learn how they're going to do that. And we'll see how specific it is when it actually comes out.
Garrett, what is Alphabet and Google saying about how they're interfering with search algorithms with the autofill and also by not fact-checking some of those local searches?
Yeah, I mean, Alphabet is not saying a lot about, some of these criticisms. There's this report this morning in the Wall Street Journal. A lot of these criticisms that were in that story are long-standing. Competitors of Google have said that they feel the algorithm is sometimes unfair, that it's a black box. They can't understand exactly how it works. Google, of course, says it needs to be a black box so that people can't purposefully game it and sort of get ahead of it in ways that Google wouldn't want them to, or that, we as users wouldn't want them to. One of the things that came up is, politicians sometimes feel, have accused without proof necessarily that Google is suppressing certain political viewpoints or toning things down on the site. I mean, Google has talked about these things when they've come up and they've sort of said, our policy is to keep things fair, et cetera, et cetera. At the end of the day, it's really difficult to know. And I think regulators really want to look inside that black box. And I don't think Google wants them to at all. And it's going to be a really tough fight going forward.
Bloomberg's Ben Brody and Garrett DeVink, thank you both for joining. And it was a tumultuous third quarter stirred by an escalating U.S. trade war with China. Hedge funds made Alibaba a top buy. Managers also placed bets on the broader market, spending big on the fund that tracks the S&P 500. And for the second straight quarter, Uber was among the most favored stocks, while Disney and Microsoft shares saw heavy selling. For more, I want to bring in Bloomberg's Sonali Basak. And Sonali, if you want to come and take a look at a chart here that I'm showing in my terminal, it is that Alibaba continues to advance against competitors like Tencent, expanding that market share. What's your take on Alibaba and the buying behind it?
It's a nice little sign for the hedge funds that bought in the second quarter. And remember, Alibaba was the biggest buy by volumes for these funds. Very popular hedge funds like David Tepper's Appaloosa and also the Tiger Clubs, which are very tech heavy. And so Uber again was, another big buy in the quarter, but they're buying off of lows. With Alibaba, the story is a little more complicated. I mean, they had a record singles day. It's interesting to see a Chinese stock that high up here right now, given the trade tensions. But with that said, it's a really good sign for Alibaba, which also, as we know, is doing a humongous listing in Hong Kong as well.
Is it notable that Uber was a favorite stock right before the lockup expired?
It certainly was, right? Because you did have so many people buying. And remember, we had it as the favorite stock the second quarter, which is when a lot of the Tiger Cubs, Chase Coleman, Andreas Halverson's Viking, Coatue, big technology fund, they are very heavy on technology. They bought in the second quarter and then endured declines. But remember, there are other big names that have sold out, like Stanley Druckenmiller. So it's not that everyone loved it, but in aggregate, it was loved. And people do like to buy off the lows. The question is, obviously, there's a lot around Uber, and whether they stick with that stock over time and where that bottom is, I think it's going to be an interesting question.
And Sonali, where there are winners, there are losers. Microsoft surprised me as a big seller, given how much gain it has made in its cloud Azure product. Why the sellers in Microsoft?
Right, just like people like to buy the lows, they like to sell the highs. So you can see some people pairing some games. I think what's interesting there is that it's the second quarter in a row again. At what point is this a trend, and at what point does this become a fan unfavorite, really? And so that was something that people didn't love too much. Disney is something that didn't love too much. There's not this universal view on technology. I think that's interesting that we're seeing in the stocks right now. We're definitely seeing winners and losers, with Alphabet being somewhere very in between.
Well, the winners and the losers, that is what makes markets. Bloomberg's Sonali Basak, thanks for joining. And coming up, financial institutions in the U.S. have been investing heavily in cybersecurity after facing foreign attacks in the past decade. That is our conversation next. This is Bloomberg. Let's get a look at the top tech calls, starting with Nvidia. Price targets rose as results from the chipmaker reassured growth trends. While the company gave a revenue outlook that was slightly below consensus estimates, Wall Street largely brushed this off. A number of firms raised their price target on the stock, bringing the average to about $220 a share, up from just over $200 earlier this week. Analysts at Barclays think Uber is just one major announcement from sentiment turning positive from negative on the stock. Food delivery and ride-hailing in the duopoly market structures can be very profitable, like travel, and we think Uber is one catalyst away from the market realizing it. That is what the analysts wrote. And Roku got a boost from analysts at Bank of America on their Black Friday outlook, raising the price target on the stock to $160 a share. Lower device average selling prices and new smart TV offerings imply a solid setup for outsized fourth quarter account growth, the analyst wrote. And that was a look at your top tech calls. Now, Jen Easterly, she's global head of the Cybersecurity Fusion Center at Morgan Stanley, believes that cybersecurity is not about computers or code, but about people. She discussed her outlook in an exclusive interview with Bloomberg's Jason Kelly at the 9/11 Memorial and Museum's second annual summit on security in New York City. Take a listen.
I see my mission now as really an extension of what I've done through most of my career in national security, which is really defending our economic security. I mean, given that a big bank is so fundamental to national security. So I think you're right. I mean, the banking sector is ahead of this problem, and we had to be because we were attacked pretty significantly in the 2012, 2013, 2014 time frame, where a group known as the Al-Qassam cyber fighters, later identified with the Iranian government, were doing what was called distributed denial of service attacks, essentially launching massive data websites so that people couldn't get to them. And it caused a panic. It was, for the first time, it illuminated the vulnerability of our critical financial infrastructure. But off the back of that, banking really got ahead of this and put in the right programs, the right processes, the right technologies, and started really investing in that talent so that we could strengthen the sector. And some of the things that we've done to come together as a sector, very importantly, to share information. I was incredibly encouraged to come from the White House to the banking, to the financial sector, to see how much sharing there is, both within the financial sector. So, big banks are super competitive about talent and super competitive about business. They're not competitive about sharing information that's going to keep the sector safe. And there's also good sharing between the government as well as the private sector, and that will continue to grow and strengthen, hopefully, in the coming years.
And so, you talked about that sort of K through gray. I love that phraseology. But when you think about your own business and the talent gap there, how do you fill that?
Yeah. So we have been successful so far in recruiting the folks that we've needed for the Fusion Center, but we've reached pretty far afield. So we, of course, had great talent within Morgan Stanley from an engineering standpoint that we brought in to help build the center, but we've gone out to academia, we've gone to the military, we've gone to the intelligence community, some of the other banks, some vendors. We have really built sort of a village, because it does take a village to be successful in cybersecurity, and it's not just about coders or developers or programmers. You do definitely need that skill, but you also need analysts who can help you understand the very complex and dynamic cyber threat environment. You need incident responders who understand how to reverse engineer malware. You need crisis managers who can deal with a major threat or a major vulnerability. So it's really building this fabric of talent that's brought in from places all around the world, because we're in New York, we're in Baltimore, we're in Glasgow, we're in Singapore, so we're truly global. And so it's tapping into a global talent market. And then, my biggest challenge has not been recruiting necessarily, but it's retention. Because in a world where there are so many opportunities for cyber talent, you have to really cultivate an environment that enables you to retain that talent. And, I strongly believe, from all of my experience leading troops in peacetime and combat, that you need an environment of psychological safety, frankly, where people can bring their imagination, they feel like they're actively listened to, where they can bring great ideas to the table, and that, I think, is the key to retaining your best and brightest.
That was Jen Easterly, Global Head of the Cybersecurity Fusion Center at Morgan Stanley. And coming up, we take a look back at this week's top tech stories, including Disney's massive launch of its streaming service, Disney+. That's next. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in San Francisco, in for Emily Chang. Now let's take a look at our weekly top tech stories. In tech, Disney is feeling the magic of the mouse. Disney Plus had 10 million customers in one day of launching its new streaming video platform. Remember, the streaming service just became available Tuesday in the U.S. and Canada. To discuss this and all of the other top tech stories of the week, we're joined by Dan Ives of Wedbush, and also with us, Bloomberg Business Week's Max Chafkin. So Dan, let me start with you. 10 million in one day. Did this exceed your expectations?
Yeah, it was a jaw dropper. I mean, if you look, Street was really looking for about 5 to 6 million, and this was really them coming out of the gates. Iger and Disney, huge in terms of sub growth. Now, some of the skeptics will say, okay, what's free? What could churn be? But nonetheless, this was really a home run coming out of the gates. You saw it in the stock. I think it's really part of a re-rating that's happening with Disney.
Max, Rich Greenfield over at Lightshed told me earlier this week that the loser is not Netflix, that the loser is cable. Do you agree?
Yeah, I mean, I think there's something to what he's saying. I mean, you know, just to take a few steps back, I mean, we don't normally see these kind of sort of old established companies do something this big, this quickly, and just suddenly seem capable of catching up to the sort of new media market leader. I mean, if this had happened in another industry, people would be blown away. And I think for sure, seeing Disney, which was kind of key and is key to the cable business, do this, it really throws into question their business models.
Dan, so bear with me while I run through the list here. I have HBO Now, CBS All Access, Apple TV Plus, Disney Plus, Showtime, Netflix. Is the joke on me? Is unbundling really saving me money?
Well, that's what, in our opinion, about $55, maybe $55, what we think the average consumer household is going to pay on streaming. I think if you look where it is today, call it about $30. So there's room for 1 to 2 streaming players in there, potentially a third, but it's also from a price point. That's why Disney priced it the way they did. That's why Apple priced the way they did. It's part of the cord-cutting phenomenon, but we believe there are going to be multiple winners. You know, I disagree a little with the prior comment in terms of Netflix. I do believe about 10 to 15% of Netflix's core customer base could churn because of what we're seeing in Disney and Apple over the next 2 years.
Well, another big story that we're following has to be Tesla. So, Max, Tesla finally clearing that big hurdle and getting that Shanghai factory up and running for mass production. What numbers do we need to see out of China to reassure investors about revenue growth and profitability and demand?
So this is a huge story, a huge business story, and huge for Tesla. China is the biggest market for electric vehicles in the world, and in terms of Tesla's possible growth, it's where a lot of the growth is going to have to come. So it's huge, and the fact that they were able to get this factory built in such a short amount of time, I can't remember off the top of my head, but it's just a number of months, is really impressive, and it really cuts against some of the negative narrative we've seen about Tesla over the last few years, last year or so.
Dan, with the factory in Shanghai, they're announcing an opening of Berlin right in BMW's backyard. Can you still assume profitability going forward?
Look, that continues to be the biggest variable. I mean, if you look at Tesla, you got to give them credit, and Musk, what we've seen the last few quarters. Max hit the nail on the head. I mean, if you look at it, China is so key. Giga 3 is really going to be the key of the story in terms of supply as well as demand. I think if you look at what they're doing in Europe, that is also key, because right now the growth is going to come from Europe and China, and thus far you're seeing sort of the street, I think, really start to believe these stories now. If they could hit profitability, the stock goes meaningfully higher. If not, then it continues to sort of be a 1 step forward, 2 steps back. That's why this continues to be a prove me story to many.
Max, your take on the accused gender bias within Goldman Sachs, along with the launch of the Apple Card?
This is the flip side to Apple going outside of its sort of core business. They partnered with Goldman Sachs. Obviously, that's a very respectable financial brand. But this is not what they do, and you saw they kind of stepped in it, because suddenly they're getting blamed for this thing that is probably a problem across the board in terms of credit. But Apple, because they're out there saying we're different. This is going to be a different kind of card. The sort of combination doesn't work, and it really kind of throws into question Apple's ability to do this kind of thing, because clearly they weren't ready for this.
Dan, when you write a note, you move markets. Apple shares closed higher today by more than 1%. And if you come and take a look at a chart that I'm showing inside my terminal, Apple's market cap, in part because of that move, now outweighs the entire energy sector within the S&P 500 as a whole. You upgraded the stock again today with a street high price target of $325 on Apple. Walk me through your call, folding in the analysis on the Apple Card.
Yeah, I mean, look, it's really about what I view as really a super cycle between iPhone 11 and 5G, and I think that's something the skeptics continue to miss. You have 400 million of the 900 million consumers within the ecosystem of Cupertino are going to upgrade. And I think you combine that with the services piece, that's really the 1-2 to this stock getting re-rated. I think the stock has a 3 in front of it going into early next year. In terms of, on the card and what with some of these tangential initiatives, it just speaks to Apple trying to further monetize monetize the install base. That's the golden jewel for them, and that's what really the street's starting to see. Definitely a stumble as we saw with Apple Card, but forest through the trees right here. This continues to be the middle innings of a re-rating story.
Arguably my favorite time of the Fridays. It is this segment recapping all of our top tech stories with Dan Ives of Wedbush and Bloomberg's Max Chapkin. Thank you both for joining. And coming up, Google Health outcry. The search giant is taking heat for its medical partnership, but the search giant says it's doing nothing wrong. That's next. This is Bloomberg. Google's partnership with one of the biggest healthcare providers in the U.S. is drawing plenty of criticism from lawmakers, and it's even prompted now a federal inquiry. However, the search giant is denying that it's misusing health data from its deal with Ascension Hospital Network. Google says U.S. law permits it to access patient records while it builds an internal search network for Ascension, adding that no data is being used for its AI research. Joining us from Boston to discuss is Diane Borg. She's attorney at Mintz, where she specializes in healthcare-related cases. Diane, great to have you, and please explain to me and our audience how this is legal.
Thanks. It's nice to be here, Taylor. So it is quite possible that this is completely legal. There are a lot of ways under federal privacy law for a healthcare provider like Ascension Health to transfer data, even large amounts of data, to a commercial partner. There has to be a very specific agreement in place, and you've probably seen this in the press quite a bit. It's called a business associate agreement, and both Google and Ascension are pointing to this agreement, saying there's a business associate agreement. It's fine, and that could very well be the case, but there's a few pieces that aren't being discussed that I think would shed a little bit more light on what's going on. First of all, if you have a business associate agreement that's appropriately entered into between the parties, there can be a transfer of data from a healthcare provider to a commercial partner. The commercial partner, by signing that agreement, undertakes a huge compliance burden. You don't just get the data and go on your way. You have to comply with federal privacy law, similar to the way the healthcare partner complies. And whether or not you've taken those steps determines whether or not the transfer is appropriate and legal under federal law, and that's probably what the government's looking at, now that they've announced that they're looking into the relationship.
So you've sort of answered the question that they seem to be following the HIPAA guidelines. I think the consumer's next question is what happens when Google employees get their hands on this data and misuse it, or there is a hack, which frankly is inevitable. It happens all the time. What then?
So I have, read coverage where there's outcry about Google employees having access to identifiable health information, but that's how a business associate agreement works. The commercial partner is being given the data so that they can do things with it, and somebody has to receive it and use it at Google in order for them to provide the service to Ascension. And if there's a breach, which there very well could be, health information is an extremely high value target. Under federal privacy law, certainly Google is subject to enforcement, but Ascension's going to own that breach because it's Ascension's partner, Google. If Google gets hacked, that would be, they would be the victim of the breach, or the patients would be the victim of the breach, but Google would be the target. Ascension would own the breach, and everybody would get in trouble.
Can you speculate on if this should be legal?
So I think there's a couple of things that are important to keep in mind. First of all, this is not an unusual transaction. Healthcare providers engage all kinds of vendors to do all kinds of different things, and that require health information. So on a daily basis, there are staggering amounts of health information being transferred to commercial partners to do things for healthcare providers. And it's really an important function of privacy law that this is allowed to happen, because healthcare providers can't do everything. They provide healthcare. They don't build platforms or provide legal services. They provide some legal services to themselves, but my law firm is a vendor of healthcare providers, and providing legal services sometimes requires us to access healthcare information. So it's an important part of federal privacy law that this is allowed, this kind of transfer is allowed. I think an equally important consideration is that just because something's allowed under federal privacy law doesn't mean that patients are always going to be happy with it. And I think when you enter into any sort of collaboration or transaction, you always have to consider what I've affectionately named as the patient freak-out factor. It may be perfectly lawful for one provider to transfer health information to a commercial partner, but will patients freak out when they find out that happened? And we seem to be having that here.
Well, just scratching the surface. That was Diane Bork, attorney at Mintz. Thank you for joining. And the moons and planets in our solar system hold an unlimited supply of untapped resources. But in 2019, moon missions by both India and Israel ended in landing failures. And the technology to mine and extract these potential water reserves on the moon and beyond is still unproven. Still, entrepreneurs at Honeybee Robotics, it's a NASA contractor, are confident about the mission and their planetary drilling systems.
The answer is yes. The technology exists. We can put something together, we can send something to the moon that can mine water. So we are sort of like a trailblazers, trying to figure out what's going on the moon, what's below the surface.
Meet Honeybee Robotics. They've designed drills used in NASA's past Mars missions and have sampling and mining systems going on future planned missions to the moon, Saturn's moon Titan, Mars' moon Phobos, and Jupiter's moon Europa.
We've been focusing on developing high-end, fully autonomous drilling systems from literally iPhone size all the way to the size that cannot fit inside this vacuum chamber behind me.
And that's why NASA has long relied on their expertise. Unlike your everyday drill from the hardware store, their drills overcome the numerous limitations of space, which include extreme temperatures and low gravity.
That means you have to be very, very imaginative, very innovative to solve these problems. You're essentially trying to do what we do here on Earth, but with a fraction of the power, with a fraction of the mass, with a fraction of the volume, and drilling is unforgiving. If you get stuck, if something goes wrong, there is no second chance.
The difficulty in drilling would delay placement of the second probe until the next day.
One of their innovative ideas, called PlanetVac, uses compressed gas to shoot material into a sample container. Its ergonomic design allows it to be inside the foot of a lander, and was chosen to go with NASA-funded payloads to the Moon and Mars' moon Phobos. For mining and extracting water on the Moon, they created the Planetary Volatiles Extractor, or PVEX, and it not only drills, it mines. It's based off a drill that removes a cylinder of material called a coring drill.
But it's not just any coring drill, it's a system with heaters on the inside. So you drill down to required depth, you heat up the material that's on the inside of a coring drill. And ice turns into vapor, and vapor moves up the coring drill into a cold finger. So you're capturing water vapor like, for example, in your freezer when you have condensation. PVEX is a mining system. It can actually get into the soil, it can actually extract water, it can actually capture this water in a separate container. We have all the pieces together and we can go to the Moon or Mars and mine it.
When it's tested on the Moon, which may happen in the next couple of years, PVEX will be the first end-to-end mining system deployed in space. And they have even more futuristic ambitions to use the PVEX drill. Like this one, that not only extracts and stores water, but uses it to propel itself, like a flying kettle.
Wine, it stands for the world is not enough. It's a James Bond stuff, it's very futuristic. It's a new concept of space exploration.
The main idea is to send hundreds of low-cost wine spacecrafts all over the solar system to give a clear atlas of asteroids that have water resources. Honeybee Robotics is one of the many startups that NASA is depending on to develop new innovative ideas.
There is a strong private-public partnership with NASA right now to come up with landers that we can send twice a year that will put payloads to the moon, payloads like instruments, like rovers, and also humans. We're doing it. It's happening right now. Very, very exciting times.
That's part of our special Bloomberg Original series called Giant Leap. You can check out more on Bloomberg.com. And still ahead from being one of the most promising unicorn startups to a failed IPO, we explain the WeWork debacle. That's next. This is Bloomberg. In less than 1 year, WeWork went from having a $47 billion valuation and being one of the darlings of the venture capital world to needing a rescue package to avoid collapsing. Bloomberg Originals presents the story of how the company got here. Take a listen.
I think when you cover IPOs and high-flying startups, you're used to seeing dramatic changes over short periods of time, but nothing in my experience has really compared to what WeWork has undergone. I think people felt like they blinked and everything was different.
At last reporting, they're running out of cash very quickly here.
Sources have told Bloomberg that the company could run out of cash by next month.
I was surprised at the vitriol and the speed with which investors apparently rejected what WeWork was trying to do.
From the first day that we started WeWork, it was about bringing people together. There's an energy that you feel. That energy is something that's hard to explain. It's something that either you feel it or you don't. We like to call it the we generation.
In less than 1 year, WeWork went from one of the most highly valued startups of all time to losing more than 3/4 of its value, ousting its rockstar CEO, and desperately needing a cash bailout from its biggest investor just to keep the lights on. In order to understand how we got here, we need to take a look into the mistakes made along the way.
The ambitious vision of WeWork is effectively dead, period.
This is a case study of when a company got too much money too fast with no effective oversight on how to spend it.
They are no longer the market leader. That company is going to get smaller, and it's never going to be 10 times bigger. I mean, the story's over.
As late as summer 2019, the co-working company WeWork was considered one of the most valuable startups with a $47 billion price tag, more than Airbnb, Stripe, and SpaceX. But in just a few months' time, that valuation has vanished, and the very future of the company is in doubt. To understand how this happened, it all starts with the company's now former CEO and founder, Adam Neumann.
Adam Neumann is the co-founder of WeWork and was its CEO for a long time. He came over to New York for college after being in the Israeli Navy and started a few businesses, including my favorite example is a baby clothes line with knee pads.
His landlord was actually showing him another building in Brooklyn when he came up with the idea of sort of subdividing that space, which Miguel McKelvey, his co-founder, who's a trained architect, sort of came up with the plans, and then boom, they were away. They started a company called Green Desk, which they sold, and that was the first iteration of WeWork, which they started in 2010.
WeWork is a new environment for the workspace. So co-working was sort of where it started. Today there's a movement in changing the way people work.
2010 was a great time to be starting a co-working company in New York City. There were a bunch of landlords with empty office buildings, vacancies. WeWork actually presented a solution for them. The very first building down in Grand Street in downtown Manhattan was where WeWork launched its first co-working spot, and from there it was sort of boom. From 2010 to 2011, it doubled in size, and from then on, the growth was exponential.
Some of their original investors were people who were involved in commercial real estate. They got some early investment from a venture capital firm called Benchmark, and eventually sort of kept growing, kept taking on new leases, and started to grow the business starting in New York City.
business grew quickly, and by 2015, the company already quadrupled its valuation to $10 billion, counting 23,000 customers, paying memberships in 32 locations, renting desks for as little as $45 per month.
WeWork's whole idea was, let's not just be a commercial office leasing company, let us accelerate the new world of how people work and make it better.
Community, being surrounded by a group of like-minded individuals, being part of something bigger than yourself, inspires people to work harder, spend more time at work, and just have fun doing it.
And initially, this attracted the attention of young entrepreneurs looking to expand their companies.
We thought it's about time to give you a tour of where we work. A tour of where we work. A tour of where we work. Hey!
You got your Cokes, you got your Red Bulls. Incredible group of people. Everyone that I've met through the WeWork community has been absolutely awesome, and all the staff here are incredible.
It's almost like a cult-like sensation that they created with the very early employees sort of realizing that WeWork was more than a company. It was a bit of a family. It was a community. And members, too, sort of realized that. They realized they could lean on each other in terms of networking, in terms of growing their own businesses.
This excitement drew in even more investors to the company.
Adam and his company, it's not 2.0, it's 10.0. I mean, he's taken it to really the next level. And when you walk into their space and you see the energy, you see the excitement, you see the interaction, it's a very, very powerful concept.
That's part of the spectacular rise and fall of WeWork, a production of Bloomberg Originals. You can watch the rest on Bloomberg.com. And that does it for this edition of Bloomberg Technology. Bloomberg Technology is live streaming on Twitter. Check us out at Technology. Be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.